So Richard, you must have sold an awful lot of insurance brokers. How do you think people actually value the broker businesses that you've ended up selling or looking at?
I think in a word, highly. The first client we ever had as Hines Associates was sort of 18 years ago, was Aon. And the then chief exec of Aon in Europe said, Richard, broker valuations are very simple. They trade between 1 and 2 times revenue. A good broker trades at 2, and that was the case. That's all changed in the last 20 years. So the simple answer to your question, Chris, is they trade on a multiple of pre-tax profits, or EBITDA, as it's often called. And the second thing about that is that the multiple that's applied to the pre-tax profits, or EBITDA, is a function of the growth rate or the anticipated growth rate in the business. And in the past, I think 10 years ago, decent sized broker, 10 or 20 million of profits, traded at 10 times, and now they trade at 15 times adjusted. That's for the big ones. Smaller ones trade at a lower multiple, and ones that are indistinguished, trade at lower multiples still. What a buyer's looking for is they're looking for a good customer base, recurring revenue, which obviously is a feature of commercial lines broker, greater than personal lines broker, and they're also looking for synergies. In simple words, that the EBITDA or pre-tax profits run through their machine gives rise to a much higher number than it does run through a smaller company. So it's quite often that you see a business that is theoretically sold at 15 times EBITDA. The buyer will claim they paid 10 times because they've got revenue and cost savings.
So is there a difference if you're a small privately owned broker versus a medium-sized one that's looking to retire? Because effectively your salary should then come out of the calculation, shouldn't it?
Yep. As your finance director, they're very frequently casualties of these things. So I think that's a very good way of looking at it. There are lots of costs that can come out of putting a small business into a bigger business. Most of the systems costs, quite a lot of costs of the compliance function. You don't need a finance director. You may or may not need the founder. You certainly don't need the founder's friends and family. You may not need all the premises. That's obviously a pre-COVID statement. Seems a bit silly now. So there are a lot of adjustments that can be made. Give you one example. There's a business that we had recently which had pre-tax profits of 700, and they were adjusted upwards to 2 million.
Wow. How do you end up doing that?
Because there were quite a lot of adjustments you could make. Legitimately. So obvious adjustments would be, in simple terms, friends and family in the business. Many brokers, as you know, either have a car habit or a shooting habit. Often quite excessively, they can come out too. I don't think this one did. You may have premises that are surplus to requirements. It's often you will not need the industry systems that you're on because the buyer will have them already, and then you can adjust revenue for higher commission rates of the acquirer, and indeed the fact that the acquirer might have a wholesaler as well. So there are all sorts of ways in which it gets adjusted. In the example I've just given you, they were the adjustments that we made. Obviously, the buyer would have made their own adjustments on top of that.
So if you're considering selling your business then, should you make those changes before you go to market, or is there not much difference between you making the adjustment and actually going to market?
Well, that's a very good question, Chris. 3 years ago, I'd have said you really ought to sort it out before you go to market. Now I say you wouldn't, because the market is such a seller's market and it's so competitive. The buyers will accept those adjustments, providing they think that they can happen on their time. And I'll give you the most outlandish examples are how do you treat acquisitions that you're about to make? And obviously, a number of the broker consolidators have sold recently. In fact, quite a lot of them sold recently, and they're always buying things. And so the question for the buyer is, do you give them full credit for all of the synergies from the business they've already bought? Tick, that gets done. Secondly, do you give them full credit for the synergies on the businesses where they're between exchange and completion? Tick, they do now. And then thirdly, do you add in all of the revenue and profits and adjustments from businesses where they say got to heads of terms? So then the answer to that is tick. And in certain, the most outlandish ones I've seen, actually acquisitions where they haven't even got exclusivity get factored in. And of course, not all those deals happen. So there's an interesting question afterwards between the investor and the management as to was the investor misled, but it's just a function of investors trying to justify the price that they need to pay to buy the company.
So that's quite interesting. In terms of the process then for selling your business, if you have a brokerage, what does the process look like?
The key things to a successful sale, because the process it sort of follows on from that, is you have to be properly prepared. And in very simple terms, that means you have to have all the numbers together, including you do need to understand the loss ratios of the business that you produce. That obviously applies more to an MGA than a broker, but a broker still needs to have it as well. So you need to have all the numbers in the right order. If there's any specific issue that needs to be resolved, for example, if you're closing a site down, close the site down. If there's an E&O claim, you work out, ensure that your policy will cover it. There are some basic things that you have to do, but what determines when to go is the business being ready, as I've just said. It needs to be being sold ideally on an upwards trajectory, i.e. that the revenues are going up and that the profits are going up, because that, as I said earlier, goes to the multiple that people pay. Those are the key things. If you're the sort of business that is making acquisitions of little portfolios of business, probably make them ahead of time. So it's just a question of timing it. I don't think there's an issue of timing in relation to will the buyers be there in 2021, 2022, 2023, because I think they will, given what has happened and given what's fundamentally driving this market. But you need to go at a time when your business looks good. It's as simple as that. And therefore, realistically, you need to start thinking about it at least a year before you are likely to go to market.
And so in terms of your process, then it is basically the conclusion that you produce a sort of information memorandum.
I think the key point I say is these processes are very distracting and they take a lot of time. So we used to think that there was a thing called M&A light and you could, do a process quickly. I don't think that's possible actually, because the amount of work that the buyer requires the seller to do for the buyer to be comfortable in what they're buying, and given what they're paying. So we would say from going to market, having written the IM you're talking about, Chris, and having written a business plan before that, going to market, a 2-round bidding process and period of exclusivity is probably 5 to 6 months. And on top of that, you've got the gap between basically signing the sale and purchase agreement and the change of control being approved and completion being able to happen. And that is anything up to 3 months. So I would normally tell someone, particularly if you allow for the preparation up front, and get your numbers right, write the IM, I think you're looking at 9 to 12 months realistically. I mean, I'd love to say it was less than that, but it isn't in most cases.
Wow, that's quite a long time. I didn't realize it would be such a sort of extended process, because with so many bidders on the market, you think that process would be slightly watered down.
Not really, because what happens is one of the reasons the process are so long is that those broker consolidators are probably looking at 10 companies at the same time. Mm. So actually they're not providing they think that they're not going to lose the deal, they're not particularly fussed. In the bigger processes with the more valuable assets, that you can potentially put pressure on the timetable.
In terms of this sort of process internally, when is it a good time to tell your staff?
Oh, what a good question.
Is the answer never?
Well, the other question is, what happens if you have minority shareholders? In terms of the way these processes are governed, an advisor like us will have the board of the company as its client in reality, and via them the shareholders, which obviously in a private company is often one and the same thing. So by definition, all of the board know. Certain people in the finance function are bound to know because they're providing information, and no one wishes to mislead their staff, but nobody wishes to spook their staff. And these processes are conducted quietly. There are non-disclosure agreements between the buyers and sellers. These processes shouldn't leak, although despite that, there are plenty of processes in the many publications that you and I read, because the story gets out. You don't need to make a public announcement to your staff early in the process. I think there's always the principle of truth. If someone comes and asks you, is something going on? I think you should answer that question truthfully. I mean, I've been through that process myself when Mercantile and General, the reinsurance company, was sold to Swiss Re, and I guessed the process before other people guessed. And I asked my boss, who was the main board director, and he told me and swore me to secrecy. But in terms of a formal announcement to staff, you don't do that till you know who the buyer is and you've got a signed sale and purchase agreement, because the first question they're going to raise, who's buying me? What does this mean? And it depends who buys you is what it means. So I would, ideally, you would not tell the staff more widely till you had a deal, so you don't have to row back on it, and you need to know who the buyer is.
So in terms of the buyers, it must be quite easy to understand, because there must be certain buyers who are looking for certain types of businesses. Is that the case, or is it, a lot more complex than that?
Well, you're asking me about how difficult is my job, Chris.
I thought I was being more subtle.
Do you want a truthful answer?
Yeah.
I suppose you do. 30 years ago, before the internet, one of the things that an investment banker had in his armoury was he had his Rolodex, which in those days really was a Rolodex. For those of you who are younger, look it up on Wikipedia. But broadly speaking, they had the phone numbers, and then eventually they had the mobile phone numbers of the chief executives of the buyers, and they knew them personally. And there weren't the big databases that there are now. You couldn't just look at everything on a screen. So in the old days, this really was part of the, if you like, the dark arts of banking. Nowadays, because there are so many databases and there's so many transactions, most people, and I even include accounting firms in this, can work out mostly who the buyers might be. The value add is knowing where the new buyers are, knowing where, for example, the new American buyers are for brokers, i.e. the ones that haven't turned up in processes yet, knowing where the Far East and the Australian buyers are. So a lot of what we do, and I'm sure our competitors do it well, is we spend a lot of time talking to current and potential future buyers to try and find out where's the new game in town, because it's that new buyer that is incredibly value added in the process.
That's really interesting, because it sounds like there's a lot of international money coming into the UK market.
Yep.
But at the same time, you hear about people like Ardonna going and buying businesses in Europe.
I think we've become international again, which has absolutely nothing to do with Brexit one way or another. It's just, if you are a big broker consolidation, you mentioned Ardonna, which is obviously huge, or PIB, these are really big businesses now. They've got most of what they want and need in the UK, but they've got a growth agenda. So they are now, as you say, they're looking at Europe, they're looking at the Far East. We were talking to an American group who's, they've got one bloke in the M&A department, we're going to help him. And he's been tasked with looking at the whole of EMEA, the Far East and Mexico. That's quite hard work if you live in Birmingham. That's a lot of people are looking overseas because they have to now. And also, the consolidation economics and logic applies in Poland just as it applied in the UK. So they are looking. So there's international business coming into the UK in the form particularly of American buyers. You'll have seen that we represented O'Leary, which is a very good business out of Cork in Ireland, and we sold it to Brown & Brown, which is a very good business out of Florida. And that's a very simple trade sale. Then you've got the American PE firms backing the big broker consolidators. You've got Canadians backing the broker consolidators. You've got the broker consolidators looking into Europe, looking to the Far East. So it's very cross-border again. And of course, London's a perfect place for it, because a lot of this business, one way or another, at the more sophisticated end, finishes up in London anyway.
That is an interesting trend, because I wrote about it in one of our InsurTech newsletters, which I'm sure everyone has been very excited to read, about how the fact that people like Bought by Many and 𝐔𝐧𝐝𝐞𝐫, etc., have built very good InsurTech businesses on a specific product category, and part of the strategy appears to be to go international rather than to go cross lines.
Well, if you look at those two, 𝐔𝐧𝐝𝐞𝐫, I think it's got business obviously here, it's got business in Italy, I think it's got business in a couple of other European countries, and that attracts the fintech investor. Trying to talk to a fintech investor about commercial lines consolidation in the UK, it's not what they do. They want things that are very specific with certain fintech dimensions, which is either products or distribution. And what they want is spectacular growth. And you mentioned Bought by Many and FTV, which I'll give them a plug. We think FTV is probably the best fintech investor in America. And I think Bought by Many is their second investment over here. They've just done the most recent round. It's about 75 million quid, I think. But because they're going to take that business into America.
Wow. That's a big growth opportunity, but isn't it surely the death of many British companies? If Tesco can't crack it, why can the insurance industry?
Well, I suppose that if you want the poster child of failure, you'd have to look at the banking industry. all the UK banks that, in the 90s bought banks all over America, didn't work very well.
No.
You'd have to have a shout out to some of those geniuses in Spain who decided it was a good idea to buy the raggedy taggy ends of the UK banking industry. So that's not about TSB. It doesn't work very easily, but typically that didn't work because you're buying national businesses and you somehow think that your knowledge is going to be additive, which it's not. Whereas if you go back to Bought by Many and 𝐔𝐬𝐶𝐞, they're saying they've got something new that is internationally applicable or applicable in multiple markets. And of course, you've got the internet on your side now.
So if you were looking at this as a major carrier and you were seeing the insurtechs like Bought by Many and 𝐔𝐬𝐶𝐞 with their very healthy valuations and rapid growth, why can't you take their marketing source and graft it onto your existing model?
Because I suppose you haven't got the right DNA, Chris, to do that. I mean, you try getting a new product through one of the large UK carriers, or compared to getting it through a bunch of young, bright things who are very focused. It's just a different thing. I mean, let me ask you a personal question. Would Stubborn Edge have flourished in the way it's flourishing had it been owned by a large broker?
No, I think I think when we started, most people thought we were mad, and probably with the growth in facial hair, they're probably looking at this, thinking the same thing. No, I think it's a very fair question because.
Let me take your business as a case study since you're on the line. So you will get that business to a very decent valuation through growing it quickly, doing something innovative and new. And you'll be able to move on at a pace that I don't think people will be able to catch you up necessarily. Just if you think about, where have you got your IT resource, where you've got your middle office, your construction's very modern in a way that other people's isn't. And then you look at the products and services you've got, they're very modern in a way that other people's aren't. You're very interesting because you cross life, general and wealth. Nobody else does. So eventually, with your blessing, I will sell you to somebody who's less bright and less motivated than you are for an enormous amount of money, and then they will make Stubborn Edge grow more slowly. might still grow faster than they can grow anything themselves, and they'll benefit from the IP. And then 5 years later, you'll do something else and build another business. It's just the way it goes.
That sounds like a compelling business plan for any potential suitor.
Sounds like a pitch.
Yeah, thanks. Thanks very much, Richard. So,
right, I'll send you the engagement letter.
One of the things that sort of fascinates me is the size of the consolidators keeps on getting bigger, and I think some statistics that I heard from Aquiline that effectively the number of UK intermediaries is no different in terms of firm size from 10 years ago, and that all of the consolidation that's happened is that there's just a larger number of small brokers, a smaller number of large brokers, and basically very few in the middle. Yep. At what stage does the consolidators consolidate the consolidated, and we end up in a position where it's just very hard to actually move the dial as a private equity business coming into this space?
Well, I mean, you've got to remember that this industry is still consolidating at the very top. So you obviously had the Aon, Willis Towers Watson transaction recently, and a couple of years back you had Marsh JLT. So this industry continues to consolidate all the way up, and the big companies, in terms of the price at which they trade as a sort of EV to EBITDA multiple, has been steadily rising. So this market's fueled from the very top. You're right that the mid-sized, what I call the mid-sized broker, so the one that's making £5 to £10 million profit each year, they're the ones that have, vast amounts of those have been taken out. So the question is, how many people out there can grow small broker into that sort of sweet spot? But it continues to happen. You've seen relatively small groups get large and valuable very quickly. I mean, CFC is a classic case. I'd probably put Nexus in that category as well. These are, I know they're not strictly brokers, but I mean, these are businesses that are growing very fast to real size and real value. So it keeps on happening is all I can say. And I think what's going on in the background is that GWP still increases a bit each year, with the exception of the aggregators in personal lines motor. Brokers have not been disintermediated by the direct model in any form. Brokerage commissions remain somewhere between very healthy and colossal, depending on how you look at it. So it still remains a very attractive business. And if you've got the biggest of the big at the top merging, then you can bet your bottom dollar that some very good people are going to fall out and build some nice businesses. So it starts again. But you're right in the sense that, can you have a limitless number of large brokers in a small market like the UK? Well, we've got quite a few now. But, we always did have. I mean, if you go back 20 years, you had the Lowndes Lamberts, the Heath Fenchurch, whatever they're called. Had a whole load of those ones that disappeared. And then you had the next wave, which was the Oval and the Giles, and they came and got swallowed. And then you get the next wave. I think we're in the fourth wave of broker consolidators now. So it just seems to be, the gift that keeps on giving. As it feeds my day job, long may it continue. I mean, but to take a different market where the same applies, but there is more of a problem, would be in the wealth management market, where there is a real shortage of targets now for the bigger consolidators.
Is that in terms of the investment managers or the actual financial advisory businesses?
It's the financial advisory businesses or the wealth management businesses or IFAs, call them what you like. If you look at the number of regulated, if you look at the number of regulated financial advisors, that number has been flat to declining, and the number of firms has therefore shrunk because the firms have consolidated. Whereas in general insurance broking, there always seems to be a spare 3,000 firms out there of different sizes.
I've always been amazed by the fact with the IFAs that there was the decline. And I remember speaking to our group actuary about it, who said that, well, it's obvious, isn't it? If you have RDR and you suddenly impose VAT on financial advice, the supply declines because you put a tax on it. And I always thought that was quite an interesting change. It's not just the commercial structure with the consumer. You did actually make it much more expensive once that happened.
Yep. And you did then, in 2016, have the commissions on group business being stopped and replaced by fees. So that was another sort of nail in the coffin. And now, of course, with low investment returns, people are focusing on the total expense ratios. But the odd thing about insurance is that people don't seem to ever be particularly worried about the brokerage percentage. And it's a lot. So if you think of a high net worth household policy, what's the commission rate on that? 40? Something like that. And you've got insurance premium tax kicking about. So if you think about the percentage of the amount paid by the client that gets anywhere near the carrier, it's 50% max.
It's a fair point, but I think the one of the trends that we've started to see is that the brokers in the high-end market, in particular, are starting to offer a lot more value-added risk management services.
Yep.
And you can see that the percentage of the premium that's actually allocated to kind of risk management, as well as that to distribution, is going to be, I think, changing more in the favour of those value-added services that sit alongside the insurance premium.
And exactly the same is happening in the wealth advisory industry, where people have worked out that low-cost index funds is the way to go as opposed to active funds. And therefore, you can actually charge more for the advice because you charge considerably less for the fund management. You're providing a much better service for the end customer at a lower cost.
Yeah, I can see that. And I think it's still surprising that the insurance industry hasn't had its Vanguard moment.
Vanguard is the example that really makes it difficult for everybody.
So you wonder when Amazon and Google are going to wake up and cause that Vanguard moment, which would be incredibly uncomfortable.
Yes, I mean, but I've wondered about Google Financial Services for a long time. But the problem is that the day job for Google is rather more valuable than financial services, and until recently less regulated. Although Zuckerberg and Facebook might have a different view on that. So sorry. As we speak, something's going to fall on me.
You've just had your account deleted.
Unfortunately, I don't have one. Sorry,
I'm sure at this very moment someone is creating a Facebook account for you.
No, I think this is what I think. I've just been cut off. That was the first attempt to cut me off on this interview. So I've definitely upset the fangs in America. Sorry.
Richard, I know you represent insurers as well as brokers.
Yeah.
If you were sitting there as chief executive of an insurance company and you were looking at all the digital change brought forward by COVID, and I think also changing consumer tastes have just moved a lot quicker, what would you do? Would you buy in your tech, buy a tech firm, or build your own, or just sit and wait and see which one comes up later and hope to get into the game at a lower cost?
Now, so now you're asking me, am I wiser than the great chief technology officers of these illustrious firms? I'm not so trapped in historic thinking and with an IT department, I suppose that I look at it. I don't think that the innovation is going to come from the large carriers. As you know, they've set up their various little hubs, and they've even a few of them been to Hoxton and Shoreditch and set up funny little labs and factories and so on. But, without wishing to insult any of their executives watching us, that's pretty childish, to be honest. A good example would be bought by many. So Munich Re Ventures has a shareholding in and also provides reinsurance capacity to it. So if it goes, so they don't have to take the risk that they can't build it themselves. They get first dibs at understanding how it works, and they get first dibs at seeing whether or not it produces interesting insurance business and interesting data. So, and it's the same thing, would I as a carrier think about having a small shareholding in 𝐔𝐲? Yep, I certainly would. And of course, after they do have a lot of money, they do better to place their chips carefully as opposed to try and do it themselves, is the way I'd look at it.
Okay. And your sort of view at the moment is that reinsurers are doing that slightly better?
Well, I think reinsurers are more set up to do it because they just have such a wide remit of geography and product.
Mm.
So, and certainly, as you know, I worked at Prudential, admittedly it's sort of head office and in fund management, and I went to Mercantile and General, the reinsurance business, which ultimately finished up in Swiss Re. But I think we were the fifth. Well, I don't think we were the fifth largest reinsurer in those days, and we were present in 30 countries, and 6 of the countries reported to me. And you had a lot of knowledge from looking at so many different things, and you're in a better position to play. So if I contrast that with, let's say, a very good motor insurer, let me pick Admiral as the obvious example. Probably the best business model you could get in that sector. Extraordinarily good at everything it does, but it's very narrow as to what it can do. And indeed, when it did try and go internationally, it found that very difficult because it's got almost a perfect business model for the UK market, when I think it has. But it's very difficult to then expand out geographically or into different verticals, given what you know. And the reinsurers don't start in that place. And also the reinsurers have so much information and so many structures. They can write on a quota share basis, they write on an excessive loss basis, et cetera, et cetera. So I think they have natural advantages.
Yeah, it's an interesting perspective.
I would rather hold a Munich Re share for 20 years than hold an Allianz share for 20 years. For a very simple reason.
I suppose you partly touched on it before when we were discussing sort of 𝐔𝐲 and that kind of side. There's been a lot of talk at the moment about MGAs either winning and succeeding or being trampled under the collapse of capacity. If you were an MGA, would you set up your own carrier? And what would that impact have on valuation? Because I know you've historically said it's a terrible idea, don't do it because you'll ruin your multiple.
Yeah, yes, I'm glad you remembered something I said to you, Chris. I still basically hold to that. A good MGA, i.e. one that looks after its capacity, will always attract capacity. So actually, for a good MGA, you don't need to have your own carrier. Typically, let's think about personal lines motor out of Gibraltar. As done 10 years ago. Lots of brokers set up carriers in Gib because they couldn't get any decent capacity in the UK because they'd burnt it. And that's a recipe for disaster because they then burn their own capacity and go bust. And Trade-wise, went bust a couple of weeks ago and fell into the FSCS. Whereas Trade-wise, the broker distributor is a very good business, but it had inadvertently burnt its capacity and it set up its own carrier and that went bust. So I think I don't like that strategy. It strikes me as a strategy for a failure and ends in a failure. So I know that upset a few people looking at this video. That's not the same as having a desire to create a direct insurer, though, which going back to what you were. So if you actually say, well, what I really want to do is I want to build a direct insurer where the insurance is part of the service I'm providing.
Yeah.
That's I think, a different strategy. But then, of course, you might say, well, actually, all I need is a front and a reinsurer.
So using the accredited type model?
Yes, but that's not a perfect model either because there are frictional costs in using a third party. There's no simple answer to this, but other than where I started, which is a good MGA will always have capacity and therefore will be fine. And an MGA that can't underwrite sooner or later will hit the buffers.
It seems that Solvency II is very hard to navigate as a small insurer because the proportionality element of the guidelines seems to be slightly lost when you set up a smaller carrier, and that you always end up chasing your tail for slightly more volume to cover those fixed costs. So I can see that it makes sense if you're going for a volume market, but if you're going for a niche sort of sector, I would have thought it's more captive related business, but then you stumble across the problem of being able to sell into countries and sell to third parties. So where it's not something that's related to your core offering.
I would agree with that. And the other problem with having the two problems with small subscale carrier on Solvency II, one is you're almost bound to have an expense ratio problem. And secondly, you don't have any diversification credit in the capital. And, understanding a bit about the pet insurance market, and if you're writing monoline pet, your Solvency II, your capital requirement on the own model is remarkably high for something that, pardon the pun, has no tail risk.
It almost makes you want to do a bit of motor, doesn't it, Richard?
All the roads lead to motor. Well, some people do motor really well.
Yeah, well, Sabre have obviously been a standout performer.
Certainly Sabre. But I mentioned Admiral before. Actually, any of the big motor carriers now, they've done pretty well for the last few years because most of the Muppets, if I can use that technical term, have been squeezed out. And you and I have probably got the same list of Muppets. But, it's a big boys game. It's a big data game. You need a lot of skill. You've got to be agile, to use that terrible word, or else you just lose a lot of money.
So do you think Tradewise as a carrier, wasn't able to raise the money because of its size, and that industry structure means that it's highly unlikely you'd be able to do so?
Well, but Tradewise did raise money on an emergency basis about 3 years ago, but it didn't raise enough and it didn't turn its underwriting results around fast enough. So even if you do raise new capital, the fact you have to strengthen your reserves probably gets you back to square one.
So unless you've got a very solid reinsurance partner behind you as well as a capital base, you're in a difficult position.
Yeah. The people who, if you take the Admiral structure, which is essentially a quite heavily quota shared structure, that only works because the quota share reinsurer makes a decent amount of money off them and has done year in, year out. And that then gives you the perfect thing of you've got a fairly capital light structure and it's sustainable, but that's based off 25 years of very good underwriting results.
Just one final question, Richard, which is a slightly sort of trick question. Would you end up backing a broker that was buying brokerages at 20 times EBITDA?
I don't think they are buying them at 20 times EBITDA.
But if the exit multiple for a consolidated group of brokers is sort of 15 to 20, would you put your own money behind it?
It depends, is the answer. There is a multiple arbitrage there still. They create the value by virtue of the fact they've got a vast amount of debt facilities at sensible cost from the debt funds behind them. And they've actually proved pretty good at buying good businesses. Whilst the group might trade at 14 times adjusted EBITDA, they've been buying in at 7 or 8 or 9 times adjusted EBITDA, which might on a statutory accounts basis look like 15. So you might pull last year's accounts for XYZ broker and have a look at it and say, well, the unadjusted EBITDA is X, but in reality, adjusted it's 2X. So it can look like 15 on a table written down by someone who doesn't know what they're looking at, but actually the buyer bought it at 8 times and then they go and finance it by debt and flog the group at 14. The world moves on. Money made. Thank you.
So where that happened in the retail sector with the kind of retail buyouts of retail fashion chains and then rapid expansion of their kind of store bases, that's all ended in tears.
But
this story has the same end with a rise in interest rates?
That was slightly fueled by the fact that he switched all the manufacturing to China and took a shitload of the cost out, pardon the technical term. Delete. Anyway, but he took a lot of the cost out, but then totally failed to spot the internet. I mean, talk about not spotting the obvious. The internet has at least happened in general insurance, and obviously it took out a lot of motor brokers along the way. Some quite notable names went west. Is there a danger? Going back to where you started, Amazon insurance broking would be interesting. Free insurance of whatever's being delivered to you, followed by free insurance of the house to which it's being delivered. I'd sign up for that.
I'm sure our broking audience are very glad to hear that.
In the conversations, we haven't spoken to Amazon, but I have in the past, ages ago, spoken to people like Google. They're not interested. Google did actually buy a very small aggregator ages ago for far too much money, and then broadly shut it down because the more they understood about it, they realized it wasn't of much use to them. I think, I can't remember what it's called. I think they paid 37 million for a couple of cardboard boxes and a wire that went into the wall. But, in the grand scheme of Google, it doesn't matter, does it?
No. My view with Amazon and Google is they pose a serious risk, but I think also getting into financial services poses a risk to their reputation more than anything, because I went to the Customer Experience Awards with Grant Thornton, and they had a nice diagram with all of the different industries, and they had fintech banks at the top right-hand corner of growth, and everyone loves them. And the bottom left-hand corner was insurers, and it was slow growth, and everyone hated them. And they said, the fintech banks, by getting into insurance, are going to drag insurance up. And I sort of thought,
it's going to drag the banks.
It's going to be the other way around. Because, the problem with insurance is you have to say no. And that is something that I think Amazon and Google will struggle with. And when the reviews start coming in and saying, well, I don't really like this as much, now you've not covered my life, house or motor.
Well, I think particularly the search engines and sites like Facebook, they're more sensitive of regulators than they were 5 years ago. There's no question that financial services within the EU and the UK is extremely highly regulated. Now that we've got the CMA weighing in as well, so you've got the PRA, the FCA, the CMA and FOS, quite a battering.
The really nice thing is you're starting to get personal liability if you sit on that board. So
who would be stupid enough to be in the senior manager regime? Yes, yes. No, I have got one of those. The non-exec premium doesn't justify the risk. No,
I can understand that entirely. And I think with directors and officers insurance going up, it shows you exactly why.
Well, here's the one that's interesting me. Now that the FCA, and the Supreme Court, have basically ruled on business interruption, and it's clear that a lot of business interruption policies ought to be active and to be paying. If, as indeed I have, you've got a business, not my own, but a different business, which has been interrupted, and for whatever reason the cover doesn't pay, given that half the insurance market are paying claims, do I or do I not have an E&O claim against the broker?
Well, I think that's the concerning thing for the broker market, isn't it?
Yeah, and we are. I mean, unrelated to business interruption, we are seeing E&O claims turn up in the middle of M&A processes at most unhelpful times.
How much do you think that's going to end up driving consolidation, the lack or availability of E&O?
Well, going back to the wealth management industry, as you know, they can't get PI cover, or it's more and more expensive, so it does. And I've heard examples of the indemnity covers for brokers rising very substantially. I mean, I haven't seen it firsthand. It's a hell of a difference. If you're paying 100 grand now and suddenly you're paying 500 grand, that's 400k off your EBITDA, multiplied by 10, you just lost 4 million quid. Poof. Yeah. Not much you can do about it, though.